Welcome to Fact Fusion YouTube channel. Before our 10 multiple choice question on journal entry in accounting, let's define and explain journal entry in accounting. A journal entry is the first formal step in the accounting process where all business transactions are recorded in chronological order. It takes place in the general journal, which is often called the book of original entry. Every time a business event occurs, such as receiving cash, paying expenses, or making a sale, it must be recorded as a journal entry before it is posted to. At the core of journal entries is the principle of double entry accounting, which means that every transaction affects at least two accounts. One account is debited and another is credited, and the total debits must always equal the total credits. This ensures that the accounting equation, assets equals liabilities plus equity, stays balanced at all times. Each journal entry typically includes the following components: the date of the transaction, the accounts involved, the amounts debited and credited, and a brief description explaining the transaction. The debit entry is always listed first and aligned to the left, while the credit entry is indented slightly to the right. For example, suppose a business receives $1,000 cash from a customer for services provided. The journal entry would debit the cash account, because cash is increasing, and credit the service revenue account, because income is earned. It would look like this: debit, cash $1,000. Credit, service revenue $1,000. This shows that the business gained cash, an asset, and earned revenue, which increases equity. Another example is when a company pays $300 for rent. The rent expense account is debited, because expenses increase, and cash is credited, because cash decreases. Debit, rent expense $300. Credit, cash $300. Journal entries are important because they create a clear and organized record of all financial activities. They also serve as the foundation for preparing financial statements such as the income statement and balance sheet. Without accurate journal entries, it would be difficult to track a company's financial performance or ensure accuracy in reporting. In summary, a journal entry records financial transactions using the debit and credit system, maintains balance in the accounting equation, and provides a detailed history of business activities. It is an essential building block in the accounting cycle. Ten multiple choice questions will follow. Question number 1. What is a journal entry? A. A summary of financial statements. B. A record of transactions in chronological order. C. A list of assets and liabilities. D. A type of ledger. Question number 2. Which book is known as the book of original entry? A. Ledger. B. Cash book. C. Journal. D. Trial balance. Question number 3. In a journal entry, which account is recorded first? A. Credit account. B. Debit account. C. Expense account. D. Revenue account. Question number 4. What is the rule of double entry accounting? A. One account is affected. B. Only credits are recorded. C. Debits must equal credits. D. Only assets are recorded. Question number 5. If cash is received from a customer, which account is debited? A. Revenue. B. Cash. C. Accounts payable. D. Capital. Question number 6. When rent is paid in cash, which account is credited? A. Rent expenses. B. Cash. C. Capital. D. Account receivable. Question number 7. Which of the following increases an expense account? A. Debit. B. Credit. C. Both. D. None. Question number 8. Which of the following is credited when revenue is earned? A. Cash. B. Expense. C. Revenue. D. Drawings. Question number 9. A journal entry must always have A. Only one account. B. At least 2 accounts. C. Only assets. D. Only liabilities. Question number 10. What is included in a journal entry? A. Date and accounts only. B. Accounts and amounts only. C. Date, amounts, and description. D. Only description. Thank you for watching Fact Fusion YouTube channel.